Welcome, everyone. Thank you for joining us today. Today's webinar is going to be on understanding the Secure Act 2.0 and how it is going to impact your retirement. Before we get started, let me introduce myself. My name is Marc Bautis. I am the founder and owner of Bautis Financial. We are a fiduciary financial advising firm located in Montclair, New Jersey. And before we get started, let me just cover a few things. While there's a lot to cover in today's webinar, we're going to leave you with some notes, so you don't need to worry about that. And as always, with what I do with these types of webinars, I invite you to join me afterwards, obviously, for a complimentary 1-hour meeting, which we can schedule for a later date. And then we can go over any specific questions, review the detailed checklist I have, and go over the parts of the Secure Act that actually may be applicable to you. All right, so let's get started. All right, so here's the challenge. The Secure Act 2.0, and Secure Act is actually an acronym for Setting Every Community Up for Retirement Enhancement. It's passed late last year. It's the most significant piece of retirement legislation since the original Secure Act, which was approved in 2019. And there's a lot of changes in this act, over 100, mostly around retirement plans. So what we'll do in today's webinar is we'll get our hands around what the key changes are and assess the implications of them. Good news is most of the benefits, or there's numerous benefits to investors relating to having more time to save, more ways to save, and more ways to use those savings or those funds in retirement. And the challenge here is it's just simply really absorbing the breadth, depth, and timing of the changes. So like I said, most of these changes went into place late last year, but they're actually effective this year and in 2024. And then some get pushed out all the way till 2028. So it's a lot of different timings that these are gonna start. So we just have to kind of figure out the timeline and when each of these is going to take place. So today we're going to place our findings under one big umbrella and highlight the key changes that are what I think are the most important changes that people should know about. So what we'll dig in today is we'll kind of compare Secure Act 1.0 and 2.0. It's really the focus today is on 2.0, but it's really, you can't really look at 2.0 without really understanding 1.0. 1.0 was passed in December 2019. Version 2.0, like I said, December 2022. And it's going to hit everyone. It's going to hit the silent generation and boomers who are thinking about estate plans, to boomers and Gen Xers who are focused on retirement, to millennials and Gen Zers who will be the recipients of a great wealth transfer in the upcoming decades. All right, so we all know taxes are complicated. They impact your savings, investments, retirement plans, pretty much anything financially that you touch. Generally, the new rules are very savings friendly. However, they require that everyone reevaluate their financial plans in order to capture the opportunities that they present. So in addition, the government sees businesses as the conduit to help expand and promote retirement savings by their employees. I always say when people, when talking to people, that the government pushes things that they want to do through tax changes and through tax incentives. And they want to incentivize people to save for retirement. And a lot of what they do is doing that is giving people tax benefits to saving through a retirement plan. Oftentimes it comes through your employer. So I want to make sure you understand how the changes will impact you, your family, and if relevant, if you have a business, it'll impact you as well. So let's get started. Everyone's tax situation is different, and you should always consult a qualified professional professional tax advisor to discuss your specific tax situation. I'm a financial advisor, and I don't provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments, and then develop a plan for retirement that takes that tax planning into account. Okay, so you're probably thinking, what parts of the Secure Act will specifically impact me and my plan for retirement? And that brings us to our first key. So the Secure Act, it's giving you more time to save for retirement and provides a lot of really good opportunities to save and reduce taxes. So what does more time to save mean? There are a number of positive changes to age limits, some allowing you to contribute longer to your plan, and others allowing you to hold off on taking mandatory withdrawals from your retirement accounts. So let's take a closer look at that. In the past, savers were forced to withdraw money from their IRAs starting at age 70 and a half. And that's whether they wanted to or not. Those withdrawals are called required minimum distributions, or RMDs. The Secure Act, it's now increased the age that you start taking those forced distributions all the way to age 75, dependent upon your current age. So as you can see in the table here, anyone currently subject and taking RMDs must continue their existing schedule. No changes. You're grandfathered into your existing schedule. What that means, if you were born between 1951 and you turned 72 in 2022, you should still take your first RMD by April 1st of 2023. If you were born 1951 to 1959 and are turning 72 this year, your required minimum distribution starts next year when you turn 73. And it's worth noting that you see a star in the table next to the year 1959. And that's because we've confirmed that there's actually a mistake in the law that would have had these people starting their RMDs at both 73 and 75. So this will ultimately be rectified in a technical correction. But for now, let's keep it at age 73. Okay, next on the list, those born in 1960 and later will not start taking RMDs until age 75. And what that does is it gives your money more time to potentially grow tax-free, or tax-deferred in this case. Remember, however, building up a large IRA or a larger IRA means larger RMDs in the future, which can have tax consequences when it's time to start actually drawing down these retirement assets. So this is one of the topics that we'll discuss if you set up that 1-hour complimentary meeting, is how best to schedule or take those RMDs. In the past, a failure to take a prescribed RMD resulted in a 50% penalty of the RMD amount. That's been reduced to 25% with a 3-year look back, and further reduced to only 10% if you correct the error in a timely fashion. And lastly, the new law eliminates RMDs for Roth 401ks, 403bs, and 457b accounts, which matches the rule for Roth IRAs. So the question becomes more about the benefits of rolling over a plan to an IRA. You want to look at investment options, fees, services, and et cetera. Okay, so now some of the new rules for surviving spouse beneficiaries. Surviving spouses can now adopt their deceased younger spouse's RMD schedule. So the primary benefit of the new rule, it would apply to older surviving spouses who now can assume that a deferred RMD start time. If they don't need the money, they can delay withdrawals, allowing for the potential of the account to grow. Another benefit is that the RMD would also be smaller than if the surviving spouse treated the retirement account as their own. So remember, RMD percentages increase with age. And finally, if the surviving spouse passes away before RMD begins, the new 10-year RMD disbursement rules do not apply, meaning the eligible designated beneficiary could stretch the payouts over their life expectancy. So here, I think RMD rules, especially when it comes to beneficiaries and surviving spouses, they can be a little confusing. So one of the things that is this rule in the Secure Act 2.0 has made it more favorable for surviving spouses and their RMDs. Previously, you could only contribute to your IRA until age 70.5, and then you'd be forced to start withdrawing RMDs for that account. The new legislation, it gives those who want to work longer more opportunities to save and the potential to create a larger nest egg when they finally retire. So I'm seeing more and more people working into their 70s. And with the new legislation, you can still save into your IRA if that is the case. Now let's talk a little bit about catch-up contributions. So first, in 2024, catch-up contributions, they'll be adjusted for inflation. Second, and this is important, if your client or you make over $145,000, it's mandatory to deposit the catch-up into a Roth account. And if the employer doesn't offer a Roth, the employee will not be able to make that catch-up contribution. Next, starting in 2025, a special enhanced contribution has been created for a very narrow bracket, and that's for people who are age 60 to 63. So if you're age 60 to 63, you can contribute an enhanced contribution of an additional $10,000 or 150% of the regular catch-up amount for 401ks and 403bs, or 5% or 150% of the regular catch-up amount for simple plans. Here, the table frames the catch-up contribution. It changes by age. So 49 and younger, your catch-up is not available. Your standard catch-up is for those people who are 50 to 59 and 64 and older, which is $7,500. The special treatment, like I mentioned in the previous slide, is for those who are 60 to 63 in 2024 And there you can contribute 10,000 or 150% of the standard in 2024. So the bottom line is that the rule changes allow for participants in IRAs, 401ks, 403bs, and simple plans to contribute more to their plans each year. So if you keep setting money aside each year, it's great news. You'll defer your taxes and you'll grow more savings for your retirement years. Now, if you're thinking that these new rules make me think I should consider putting more money aside for retirement, it's definitely a good thought, because that's what the Secure Act is trying to motivate people to do. And that includes Roth plans at work, auto-enrollment in plans, and help for part-time workers, and then also for younger families and professionals. So let's take a look at these, and we're calling this our second key. So aside from the more time to save, the Secure Act, it now provides more options to invest for your retirement. You'll see many coming slides address changes to workplace retirement plans. So a lot of people are covered by workplace and retirement plans. Let's explore this important component and how they relate to your retirement funding efforts. Okay. So first, there are a significant number of changes related to Roths, and this is both for personal retirement IRAs and also for employer-sponsored Roth 401ks or retirement plans at work. So clearly, starting in 2023, the addition of employer contributions to the Roth side of the plan equation, it's a great opportunity to build assets that will escape taxation when you begin withdrawing. So remember, you're always going to get a benefit on the retirement contribution on either side, either in a traditional or pre-tax manner, which means you get the deduction for your contribution in the year that you make it, or in the Roth manner, which means you don't get the tax deduction in the year you make the contribution, but withdrawals, as long as they meet the Roth requirements, are going to come out tax-free. So one important thing to note here is that it's not mandatory or automatic for employers offering you matching after-tax contributions to company Roth plans. It's entirely at their discretion. So for those employees making more than $145,000 annually, your only option is to have catch-up contributions to a Roth account. The only exception is if the plan doesn't offer a Roth option. So obviously no RMDs will be required here. And it's worth mentioning again, RMDs will be eliminated for Roth 401ks, 403bs, and 457B accounts starting in 2024. So if you don't want to, there's no need to roll the Roth 401k to a Roth IRA simply to avoid RMDs, although there may be other good reasons to roll it over that may exist. Okay, now starting in 2025, to encourage and increase retirement savings, your employer is required to auto-enroll you into their 401k or 403b plan. And then what you'll do is you're not forced to stay in it. You'll actually have the chance to opt out if you like. But because people dislike or very rarely take action, it's more likely that what the government will get the intended consequence here of auto-enrollment is that people will stay in their 401k plan. So in year one, the employer will determine how much of your salary they can allow you to put aside for savings. And this auto-enrollment, it'll either start at between 3% and 10%. In years two and going forward, that number will increase between 3% and 15%. In addition, the number will auto-escalate by 1% annually. So those new to the workforce or changing plans or jobs in 2025, they stand to benefit the most. Studies have shown that auto-enrollment, it's increasing 401k balances. So like I said, Congress wants to continue the good work. But we all know the earlier that you start, the greater the potential to save more money for retirement is. So I'm a fan of auto-enrollment. I'm a fan of just automating as much as you can with your finances. So I think this is a good provision. Now, even if you're in an existing plan and you're not subject to auto-enrollment, it still may be a good time to look at your own 401k savings and consider if you're saving enough. Is it the right place to put your retirement savings, or how much will your employer match? You know, table stakes. Are you making sure you're getting the maximum match that's available to you? So there are some businesses or business types that are exempt from auto-enrollment requirements. And this is also something that we can discuss in that one-on-one consultation to see if it does affect you. Okay, now companies have more freedom to offer annuities inside 401k plans. So why is this important to you? One of the hardest parts of retirement income, it's making your total savings last the rest of your life. What annuities are, they're insurance products designed to turn a portion of your savings into a stream of income that lasts a lifetime. So they're an interesting solution to help address the question, will I live to an advanced age and run out of money. Now, these are not, the panacea to retirement, because if you're not saving enough, the fact that it goes into an annuity isn't going to mean much, because if you don't have enough savings, annuity is not going to help you, produce enough retirement income that you can live. But do they solve some problems? Yes. Okay, the new legislation, it's casting a wide net and providing small businesses another way to attract, retain, and help their employees save for retirement. So there's something that's called a starter 401k. And it may not be as attractive as a traditional plan, because employers are not required to match your contribution and contributions can be lower. It is, however, a path in the right direction to help boost people's overall retirement savings. Next, we have some good news for part-time workers who also may want to save for retirement. Employers with a 401k plan must allow employees to contribute to their plan once they've worked at least 500 years for 3 consecutive years or 1,000 hours throughout the year. This is especially good for some women who may work part-time for caregiving or reasons and often have less saved for retirement. Heads up, if you're a part-time employee, check with your employer about when your 500 hours start and end. It may not be as clear as a calendar year. Okay, for 2023, the Secure Act adds 2 new options for Roth contributions to simple and SEP plans, although it won't be a requirement for you as an employee to put this in place. If it's there, basically, if you want to take advantage of it. So effective in 2023, you can offer your household employees, nanny, or cleaning person a SEP IRA plan. It's a nice benefit dependent upon your financial circumstances. Simple and SEP plans for Roths provide it's a really simplified way for small businesses with 50 or fewer employees to contribute to employee savings and yours, and if you're the business owner. Previously, simple and SEP plans only allowed pre-tax funds, which are taxed, like I mentioned earlier, when you make the withdrawal. Additional employer contributions will be allowed for simple IRA plans in 2024. These are capped at $5,000 per employee, in addition to the required matching, or 2% of pay elective non-contribution. So you can match 2%, or it's really not a match, it's really a contribution of 2% of your employee's pay. Once again, there still may be good reasons to roll a simple IRA or SEP into a Roth IRA. It could be the availability of investment options, fees, and, you got to look at the service you'd be getting. So they all should be part of the considerations that you take. This law was just passed in late 2022, so it'll take some time for participating employers to set up their systems and procedures in alignment with the IRS rules. Okay, these rules are especially beneficial for new families and young professionals. Highly compensated individuals are ineligible, but money must be held in cash or equivalents, and participants must have monthly access to the funds. So look, if you take it from this perspective, many Americans don't have an emergency or rainy day fund. This emergency savings account, it can provide a way to regularly set aside some money every year for unexpected expenses. And you get to do this by using your retirement plan. While it's only offering you $1,000 annually, the definition of what qualifies as an emergency withdrawal is broad, and it seems to account for many circumstances. So what you can do is set aside money for an emergency in your retirement plan and then actually use it if an emergency does come up. There's a new student loan repayment match where employers can help employees who are paying off student loans. An employer can make a matching contribution on behalf of their employee in a 401k, 403b, 457b, or simple IRA with respect to qualified student loan repayments. This will be available to employers starting in 2024. In addition, younger earners can start contributing to an IRA with an expanded definition of earned income. So remember, you can only contribute to an IRA if you have earned income. Earned income is income from work, whereas the converse is passive income, which is you can look at as income from investments. So this is good news for students who want to begin accumulating tax-favored retirement savings. And in many cases, graduate study keeps them too busy for a job that might offer a 401k or an employer savings plan. So you can look at it as the earlier you get started, or being able to pay off these loans, you have time on your side, and that's the best benefactor that you can have. There's new disclosures that are required. These will help you show how your total savings will translate into monthly income, which can really help with discussions about retirement, especially future cash flows and the income you'll need. And again, going back to that question that everyone wants to answer is, am I saving enough and will I run out of money in retirement? So now you're probably saying, I see how I'll have more time to save. Can the new rules help me out in other ways? Short answer is yes. The new legislation, it's made sweeping changes to how you can use the money, from 529 conversions to funding long-term care. So let's explore a few of the most prominent changes that you need to know and how they have, or what the broad application is for investors. So we all want to feel smart and responsible about how we handle our money. Now I'm going to show you some of the parts of the Secure Act that will give you some new ways to utilize those savings that you're contributing or making in the retirement plan. So you'll have a new way of, or a new option of making your charitable contributions or donations more tax efficient. You're also going to be able to maximize your college savings accounts, your 529s, in new and interesting ways. And finally, there's some new reasons you can take money from your retirement account if you need to, without paying an early withdrawal penalty. So you may be familiar with qualified charitable distributions, or QCDs. And if you're not, QCDs were introduced in 2006 to help people who were 70 and a half or older satisfy the required minimum distribution. And the way it works is you make a charitable gift with the money directly coming from your IRA account. So if certain rules around these were met, you can directly transfer up to $100,000 annually from the IRA to a qualified charity of your choice. And again, that donation would satisfy the RMD requirement for that year. Effective in 2024, the new law maintains the maximum transfer amount of $100,000, but it will be adjusted for inflation each year. And it's important to note that it must be a qualified charitable donation. It's best to check with your tax advisor, because there are some organizations like private foundations that are actually ineligible for donations under this law. Beginning this year, 2023, the new QCD law also allows for a one-time only ability to fund what's called a split interest entity up to $50,000. So it can get a little technical on what the requirements are here. And again, if anyone wants to discuss this, we can do it in a one-on-one consultation. I'm happy to have that follow-up conversation. Okay, now some changes to the 529 accounts. So the first one, it's a rule change that allows you to use money originally set aside for your kids' or grandkids' education. No need to dip into savings earmarked for retirement. Investors who have a 529 education savings plan can now withdraw up to $10,000 a year to repay student loans. So we all know that student loan debt, it's a crisis in America. The new provision, it's one way that savers can find relief, allowing them to put less money towards student debt and more towards retirement savings. A related change is that 529 plan funds can also be used for apprenticeship programs, provided they are registered with the Department of Labor. Some kids don't go to college, but still need money to prepare themselves for the workplace. One of the questions I always get is, what happens to my 529 plan if my child doesn't go to college and they want to go to a trade school? So now they can use those 529 plans that you've already have funded. You don't have to worry about the funds not being used. And in the case you forgot about this, $10,000 per year is allowed to be withdrawn from your 529 to cover private kindergarten through 12th grade education. So this was actually a rule change in 2017 that was made, but some people may not be aware of it. Now, again, going back to that, what happens if I don't use my 529? It's a question, like I said, gets used all the time. There's a new rule that it could make it easier to save for your child's college and also jumpstart their retirement savings. So here are the details with this. Excess funds in a 529 plan can be rolled directly into a Roth IRA for your child, who's the beneficiary. There's a couple of provisions. The beneficiary must have earned income. And as with other rollovers, the way it works is you're not taxed on the transfer of the funds, and the money continues to enjoy tax deferral until withdrawn. Starting in 2024, you can roll up to $35,000 total from the lifetime from the 529 plan into your child's Roth IRA. The annual transfers, they're also subject to annual Roth IRA contribution limits, which are currently $7,500 per year. Another benefit to this rule is that there's no income limit for participants, meaning that while high wage earners who are $144,000 plus if you're single, $223,000 if you're joint, usually make too much money to contribute directly to a Roth. They'll now be eligible to do so for their kids or grandkids with leftover 529 money. Some strings attached on this. First, a 529 plan must be in place for 15 years before it's eligible for a rollover to a Roth IRA. Money added during the past 5 years can't be used. And if you max out the 529 transfer for the year at $6,500, the beneficiary, who's the child or grandkid, can't add other funds from other sources. So that's what the Roth is capped out. It's the annual limit for Roth IRAs. But the bottom line here is we have some flexibility now when you have excess funds in the 529 plans. You can keep all the funds in the 529 without penalty, and your child can use the money for their children. And it can almost be like a legacy, estate planning tool, or you can transfer the funds to jumpstart your child's retirement. And best situation obviously depends on your unique situation. All right, there's also several new items that have been added to the list of penalty-free withdrawals that you're allowed to make from your qualified retirement account beginning at age 59 and a half. So one is paying for long-term care insurance is now one of them. This is a tremendous benefit for a few reasons. As we age, more and more of us will encounter a major health event that requires long-term care, such as in-home medical assistance or a nursing facility. The high cost of care for an unplanned critical illness or health crisis, it can be catastrophic for families, and unfortunately, Medicare doesn't cover much of it. The average cost of a private room in a nursing facility can be over $100,000 a year, depending upon where you live. Many people don't wind up getting long-term care insurance because it is very expensive. But as you can see, the cost of care, it's expensive as well. So you really have to look at it from, does it make sense to buy insurance, or does it make sense to self-insure? All right, so we got another way to be able to withdraw money penalty-free from your IRA, and that's for parents of new children. So this change, it's from the original 2019 Secure Act, but I just want to go through it again. Penalty-free IRA withdrawals up to $5,000 per parent if both parents have a qualified plan. It's allowed within a year of birth or adoption of a new child to the household. And what we mean by that, it's not retroactive to the children born prior to the 2019 Act. Twins or triplets, it's $5,000 per child per qualified parent. And we can discuss those numbers, what those numbers look like if you're interested, or if it's applicable to you. To meet the requirements, the individual must take a distribution from their retirement account within 1 year of either the date of birth or the date of which the adoption of the individual under the age of 18 is finalized. Even though there's no penalty, you may still owe taxes on the money withdrawn as ordinary income, unless it's coming from a Roth or after-tax contributions are withdrawn. The distributions can be paid back into the plan anytime without a time limit, but you want to consult with your tax advisor on how to report this on your tax return and whether previously paid taxes can be recouped on this. And of course, it means less savings for retirement. So you do have to take that into consideration as well. So be sure to talk to a financial advisor to see if withdrawing the money is a good move based on your overall financial plan. All right, now penalty-free withdrawals for other circumstances. So there's several new provisions that have been made allowing for special circumstances. Early withdrawals will qualify as penalty-free for someone who's terminally ill, for victims of domestic abuse, for public safety workers, which now include firefighters and others. There's also been a provision made for expenses coming from a federally declared natural disaster. So this rule, it's retroactive to disasters occurring in 2021 and later, and it allows for a maximum distribution of $22,000, which may be both taken and repaid over 3 years. So if anyone's familiar with the COVID disaster loan, it's similar to that with just a different, in this case, it was 22,000 versus 100,000 with the COVID loan. All right, undoubtedly, there's some of you in the audience who have already accomplished saving enough for retirement. Great job. And you're starting to think about the next generation and estate planning and wondering, all right, what do we need to know about leaving our IRAs to our kids? Is this still allowed in the new rules? And now we come to key number 4. So unfortunately, the news here isn't so good. The fourth key point is your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. So this was a big rule change in 2019. And again, it's worth addressing today. So not only are your retirement savings affected by these new rules, but the death of the stretch IRA, it requires a review of your estate plan and the way you're kind of approaching it. So let's look at this a little closer. With certain exceptions, which we'll see in a moment, beneficiaries of IRAs, including Roth IRAs, must liquidate the accounts within 10 years. Previously, IRA owners were encouraged to have younger beneficiaries because they could stretch out the distributions over the beneficiaries' lifetimes, allowing for longer tax-free growth. Some heirs even plan to use the accounts for their own retirement. But now they must take out the money within 10 years of the death of the original owner. So this could actually have major repercussions for the beneficiary. When they withdraw that money, they'll have to report it as income and pay taxes. This could also affect their FAFSA, which is a student loan application form, if they have children applying for college financial aid, and possibly limit the ability to claim certain tax credits. So there's definitely an impact potentially on inheriting an IRA and how you take the distributions. There's no rule about how to draw down the account, provided it's gone within 10 years. So the beneficiary could take out some each year for 10 years. They could take out nothing for 9 and take out everything in the 10th year. They could take out everything all up front. A clarification to this rule has been published pertaining to whether the original owner had begun taking RMDs and how that should be handled. And again, I'm happy to discuss that on that one-to-one consultation if you'd like. So here, the bottom line is planning is needed, and it should include consulting with your accountant. If you have a large IRA balance and you know it will be part of your estate, it's definitely something that you want to look and analyze and see if there are strategies out there that you can take advantage of. There are exceptions to this new 10-year rule, and they include surviving spouses, disabled or chronically ill beneficiaries, those who are not more than 10 years younger than the original owner, and minor children. So in that last case, the 10-year clock starts when they reach the legal age of adulthood and doesn't include grandchildren or other relatives of the original IRA owner. So for all these eligible designated beneficiaries, the stretch IRA, it's mostly business as usual. The new rule also does not apply to people who've already inherited an IRA, only those who inherit one in 2020 or later. The real lesson from all these changes, particularly the death of the stretch IRA, is that tax planning is more important than ever. Congress is looking for ways to increase revenue. I don't think that's a secret. One of them is to eliminate tax breaks. We may see other changes before time comes for you to retire or pass on from your estate. So like I said, it's definitely important to do some tax planning around your retirement. For many years, or even decades, people were told, rely on your IRAs, and many Americans listened to it to the point where, helped by a 10-year plus bull market, they have a lot of money invested in these tax-deferred accounts. The problem is one day the tax bill will come due, and you can't predict what the new tax law will be when it does. So as I said, I'm not a tax professional. I don't give tax advice, but I can look at your investments and savings and help you plan ahead. Taxes in retirement, they're a bigger issue than many people realize. So one of the things that we help people do is development of a retirement income plan so that you draw down your accounts in the most tax efficient way possible to meet your requirements. Some of our strategies may involve Roth conversions, managing the tax bracket, reviewing your beneficiaries, including trust, creating an estate plan that makes sense for everyone in your life. Okay, so hopefully I've conveyed to you the importance of new retirement rules brought by the Secure Act, and you can see how important it is to focus on what's going on in your life and how these rules impact them. So you're probably wondering what the next steps are. First, let's look at the key points that we covered. All right, so we started the presentation by saying the Secure Act changes retirement rules, and that means current and future retirement plans need to be reviewed and adjusted. Our first key point, new provisions of the Secure Act give you more time to save for retirement, but you need to know how these provisions work so that you can take advantage of them. Second key point, the Secure Act gives you more ways to save for retirement. Third key point, the Secure Act provides smart and responsible new ways to use those retirement funds. And then the fourth and final key point, the death of the stretch IRA means that your kids can still inherit your IRA, but they can only defer tax for up to 10 years. All right, so we covered a lot here today. And I hope we agree that these new rules are sweeping and widespread, yet mostly positive. So since everyone's situation is different, it's important to engage your tax advisor. My firm and I have worked with our clients' accountants and attorneys for years. We feel that communication between our camps, it's critical to your investment, retirement success, tax success. So as a next step, we offer, like I mentioned, one-on-one consultation to address any questions that you have. We have a detailed checklist that we're happy to go over the new rules and really focus on the ones that are specific to you. Then we can discuss next steps and whether you'd like me to review your retirement plan. So you can schedule that call at www.bautisfinancial.com/call. All right, and here's my contact information. Thank you everyone for joining us, and I hope to talk to you all soon.